What if I told you your first $1,000 could change your financial future? Most people think investing is complicated, risky, or only for the rich. So they wait. They save money in a bank account that barely grows, hoping they'll figure it out later. But here's the truth. Investing early is far more important than investing big. That first $1,000, it's not just money. It's the foundation of your future wealth. And in this video, I'm going to show you exactly where to put it, how to grow it, and the biggest mistakes to avoid. Because the sooner you start, the more time your money has to work for you. Let's break it down. The power of starting early. Why $1,000 today is more valuable than $10,000 later. Most people believe they need a lot of money to invest. So they wait until they have more income, more savings, more knowledge. But the biggest mistake you can make? Thinking time doesn't matter. Here's a simple example. Imagine two people, Sarah and Mike. 1. Sarah starts investing at 25, putting in just $1,000 per year for 10 years, then stops. 2. Mike waits until he's 35 but invests $1,000 every year until retirement. By the time they retire, who has more money? Sarah. Even though she invested for only 10 years and Mike invested for 30, Sarah's money had more time to compound. This is the power of compound interest. Money invested today has decades to grow, multiply, and work for you. And the best part? You don't have to be a stock market expert. You just need a plan. Where to invest your first $1,000. The smartest options for beginners. If you're starting with $1,000, where should you put it? Let's break down the best beginner-friendly investments that will grow your money over time. Option 1. Index funds, the set-and-forget strategy. If you want a simple, low-risk, high-return strategy, index funds are the best place to start. An index fund lets you invest in hundreds of companies at once, instead of picking individual stocks. The most famous? The S&P 500 Index Fund. It tracks the top 500 U.S. companies and has historically returned 10% per year. That means your $1,000 could double in about 10 years, without you doing anything. Why index funds? Low risk, diversified across multiple companies. Proven growth. The market has always recovered from crashes. Perfect for beginners. No stock picking required. Apps like Vanguard, Fidelity, and Schwab allow you to invest in index funds with just a few clicks. If you're looking for the easiest, safest way to grow your first $1,000, this is it. Option 2. ETFs diversification with flexibility exchange traded funds, ETFs, are like index funds, but even more flexible. They trade like stocks, but give you exposure to multiple investments at once. Some of the best ETFs for beginners include 1. VTI, Total Stock Market ETF, covers the entire U.S. stock market. 2. SCHD, Dividend Growth ETF, focuses on high-quality dividend-paying stocks. With ETFs, you get automatic diversification while keeping your money liquid. It's a great way to start small and build up over time. Option 3. Dividend stocks, getting paid while you invest. If you want passive income while your money grows, dividend stocks are a great choice. Dividend stocks are companies that pay you money just for holding their shares. Even if the stock price doesn't skyrocket, you still get paid regularly. Some of the best-known dividend stocks? 1. Coca-Cola. 2. Johnson & Johnson. 3. Procter & Gamble. These companies have been paying dividends for decades, even through recessions. If you reinvest those dividends, your money grows even faster. This is a great way to build wealth while generating passive income. Option 4. A small portion in crypto high risk, high reward. Should you put some of your $1,000 into cryptocurrency? It depends on your risk tolerance. Bitcoin and Ethereum have seen huge long-term growth, but they're also extremely volatile. If you do invest in crypto, keep it small, maybe 5–10% of your portfolio. That way, if it grows, great. If it crashes, you're protected. Now that you know where to invest your first $1,000, let's talk about something even more important. Because making money isn't just about choosing the right investments. It's about avoiding the biggest mistakes that can wipe out your gains. And that's what we'll cover next. Now that you know where to invest your first $1,000, it's time to talk about something just as important: how to protect your money and avoid costly mistakes. Because the truth is, most beginners lose money not because they pick the wrong investments, but because they make emotional decisions, chase hype, or fail to stick to a strategy. So let's break down the biggest mistakes new investors make and how you can avoid them. Mistake hash 1. Trying to get rich quick. One of the most common mistakes? Chasing fast money. You see a stock or crypto that's about to explode and think, if I put in my $1,000 now, I could double or triple it overnight. But here's what usually happens. You buy in at the peak, right before it crashes. The price drops 50%, 70%, even 90%. And now you're stuck holding an investment worth a fraction of what you paid. This is how most beginners lose their first $1,000. The solution? Think long-term. Invest in proven assets like index funds, ETFs, and dividend stocks. Ignore hype and speculation. Focus on steady growth. Remember, real wealth isn't built overnight, it's built over decades. Mistake #2, panic selling. When the market drops, the stock market goes up and down. It's completely normal. But when beginners see their investments drop 5%, 10%, or even 20%, they panic and sell. They think, I need to get out before I lose everything. But history proves that the best investors stay calm during downturns. Let's look at past market crashes. 1. 2008 financial crisis. The stock market dropped nearly 50%, but those who held on saw it recover and reach all-time highs. 2. 2020 COVID crash. The market lost 30% in just weeks, but rebounded to record highs within months. 3. Dot-com bubble tech stocks crashed, but many high-quality companies came back stronger than ever. If you panic sell, you lock in your losses. But if you hold and keep investing, you give your money time to recover and grow. Mistake #3. Putting all your money in one investment. Diversification is one of the most powerful risk management tools in investing. But many beginners make the mistake of putting all their money into one stock, one crypto, or one asset class. What happens if that investment fails? They lose everything. The solution? Spread your money across different investments. Use index funds and ETFs to invest in hundreds of companies at once. If you buy individual stocks, make sure you own multiple industries. If you invest in crypto, keep it a small percentage of your portfolio. Diversification protects you because even if one investment struggles, others can balance it out. Mistake #4. Waiting for the perfect time to invest. Many beginners delay investing because they're waiting for the perfect moment. They think, I'll start when the market crashes. I'll wait until I understand everything. I need to save more money first. But here's the truth. There is no perfect time. Even professional investors can't predict market highs and lows. And waiting too long? It costs you more than any stock market drop ever could. Instead of waiting, start now, even if it's small. Because the longer your money is in the market, the more time it has to grow. Now that you know how to avoid these common mistakes, let's take things one step further. Because investing isn't just about where you put your money. It's also about how you build long-term wealth. And in the final part, we'll break down how to keep investing, grow your money consistently, and turn your first $1,000 into something much bigger. Now that you know where to invest and how to avoid costly mistakes, it's time to focus on the bigger picture. How to grow your investments beyond your first $1,000 and build long-term wealth. Because investing isn't just about starting once and forgetting about it. It's about staying consistent, making smart financial moves, and allowing your money to multiply over time. So how do you go from investing your first $1,000 to building serious wealth? Let's break it down. The power of consistency. How small investments turn into big wealth. The biggest misconception about investing? People think you need large amounts of money to see meaningful growth. But the truth? Wealth is built by consistently investing small amounts over time. Let's say you invest $1,000 today. That's a great start. But what happens if you add just $100 every month? After 10 years, assuming an average market return of 8%, your money would grow to over $22,000. After 20 years, over $62,000. And after 30 years, more than $150,000, all from small, consistent contributions. The key lesson? Investing isn't a one-time event, it's a habit. The more you contribute, the faster your wealth grows. The longer you stay invested, the bigger your returns. And the best part? Even if the market goes up and down, time smooths out the risk and maximizes your growth. This is how the world's richest investors build their fortunes, not by timing the market, but by staying in the market. How to automate your investing and build wealth on autopilot. One of the best ways to guarantee success in investing is to remove emotions from the process. Because let's be real, when the market drops, it's tempting to panic sell. When prices are high, many people hesitate to buy. The easiest way to avoid this? Automate your investing. Set up automatic deposits. Most investing platforms allow you to automatically invest every month. Use dollar cost averaging. Instead of trying to time the market, buy a fixed amount regularly. Forget about checking your investments daily. The best investors stay focused on the long term. By automating your investments, you make sure you're always contributing regardless of market conditions. And that's what leads to long-term wealth. How to reinvest profits and accelerate growth. Once your portfolio starts growing, there's one powerful trick that can take your wealth building to the next level. It's called reinvesting your gains. Instead of withdrawing your profits, put them back into your investments. If you own dividend stocks, reinvest those dividends. If your stocks or ETFs go up in value, use the gains to buy more shares. This creates a compounding effect where your profits start making even more profits. It's like a snowball rolling down a hill. The bigger it gets, the faster it grows. The wealthiest investors in the world don't just make money. They reinvest and multiply it. And over time, that's how you turn a small portfolio into serious wealth. Your first $1,000 is just the beginning. Let's recap. You now know where to invest your first $1,000. Index funds, ETFs, dividend stocks, and a small portion in crypto. You've learned how to avoid beginner mistakes, panic selling, chasing hype, and waiting for the perfect time. And you've discovered the key to real wealth, staying consistent, automating your investments, and reinvesting your profits. The question now is simple. Will you take action? Because the hardest part of investing isn't making money, it's getting started. If you wait too long, you'll miss out on the power of time and compound growth. But if you start today, even with just $1,000, you're setting yourself up for financial success. The best investors aren't the ones who start with the most money. They're the ones who start early and never stop. So, are you ready to take control of your financial future? Because the sooner you start, the bigger your wealth will grow. Like and subscribe for more investing strategies, financial tips, and wealth-building insights. What's your next investing move? Let's discuss in the comments.